Sanofi stock is trading at a trailing price to cash flow of just 9.1 times, which is a 10-year low for Sanofi. And better still, they have a current dividend yield of 4.7%. But is the market mispricing Sanofi stock, or are there valid risks to be uncovered? This video will be an in-depth analysis of Sanofi stock, covering business operations, fundamental, and technical analysis. Sanofi is a global pharmaceutical company headquartered in France. They currently sell products in 160 countries, according to their most recent annual report. By revenue, they're one of the largest pharma companies in the world, with nearly 44 billion euros in revenue as of fiscal year 2025. With 51% of revenue coming from the United States, 21% from Europe, and 28% from the segment titled Rest of World. In terms of the number of products Sanofi sells, this is where they stand out in the pharma space, with a relatively well-balanced portfolio of medicine, which we can see through the revenue distribution by product, which is spread across many different products and therapeutic categories, except for Dupixent, which is their single largest revenue contributor at 36% of revenue, which might sound like a concentration risk, but for reference, Merck, another major pharma company, has two products that account for 57% of their total sales. Since Dupixent represents a meaningful proportion of Sanofi's revenue, this makes the patent expiration especially important. And in the US, their largest market, their patent on the compound is ending fairly soon, in 2031. And in the EU, their other dominant market, their patent ends in 2032. This pending patent cliff for the US and EU markets is likely the main cause for Sanofi's recent fall in price, since revenue from Dupixent will likely fall dramatically once the patent exclusivity ends. So their other current and future products will have to compensate for the transition of Dupixent. Their total current portfolio has 38 product lines, with 50% of them growing year over year, some of which growing rapidly like Altuvio, Zenpozim, and Sarclisa, while 42% of their portfolio has declined in revenue year over year. And three products, or 8% of the portfolio, was just launched and began generating revenue as of 2025. So half of Sanofi's current portfolio is growing, but what about their future growth prospects? Their pipeline looks to be well stocked across various therapeutic categories, including immunology, rare diseases, neurology, oncology, and vaccines, with a total of 60 product indications, with 25% of their product indications in phase 1, 37% in phase 2, 30% in phase 3, and 8% in the registration phase, with the most likely candidates for future revenue being in phase 3 and the registration phase, since phase 2 is often where products fall out of the pipeline, and registration is the phase where the products are in the final approval stage. Another way to look at the pipeline is by the total number of new medicines, rather than number of indications, since some medicines are in multiple phases and treat more than one indication, but the patent rights for the designed molecule rather than the indication is what matters most. So the real number of new products in Sanofi's pipeline without overlap is 46 new medicines, which is greater than their total current portfolio of 38. So in time, any one of these products could become the next Dupixent, or at least continue to grow Sanofi's future revenue, while their older products fall off patent protection. Now let's cover the macro level advantages of Sanofi's business. The most prominent advantage that comes to my mind is that Sanofi is a large and well-established pharma company, which translates to having a large research and development budget, which, as of 2025, represented 18% of their total revenue at 7.8 billion euros. And having a large R&D budget means they will continue to develop new treatments and generate revenue into the future, assuming they're able to continue successfully developing new medicines. Another component of Sanofi's large R&D budget is that it has enabled them to implement AI with the intention to develop new medicines. And in their annual report, they label themselves as an AI-powered biopharma company. Although it's hard to say if this is just marketing hype or if they have already benefited from artificial intelligence in any tangible way. Regardless, though, the pharma industry is reported to be one of the most prominent beneficiaries of AI, and I would assume the large-scale companies like Sanofi would be the ones to utilize AI and potentially profit from it. Another method that Sanofi has used and will continue to use to generate revenue growth is through acquisitions, which they've done recently, having acquired various products and companies, including the major acquisitions of Blueprint and Vicibio for a total value of 9.4 billion euros in 2025, which is another positive function of being a large-scale pharma company. Another advantage to Sanofi's business is that they're globally diversified, selling products in roughly 160 countries, and they derive 49% of their revenue outside of the US. And with global tensions rising, diversification by geography feels like a prudent strategy. Considering global tensions and the risk of recession in multiple countries looking possible, pharma is a relatively robust industry to be invested in fundamentally, which we can quantify by looking at recession sales for some of the top pure-play pharmaceutical producers between 2007 and 2009, like we see here with Eli Lilly, Merck, and Sanofi. Although the products these companies sell today are different than they were during the recession, and share prices still fell dramatically despite stable revenue. Despite pharma companies like Sanofi offering some macro level business advantages, there are some risks to consider. The most apparent in Sanofi's case being that 36% of revenue comes from a single product, Dupixent, and that product is set to lose patent protection soon, making the rest of their current product portfolio and their R&D pipeline vital, as these products will have to compensate for the revenue gap that will be left behind from Dupixent. But this seems to be the typical trade-off with pharma companies. The stock sells off when patent fears rise, and miraculously, many large pharma companies continue to create new products again and again, while maintaining dividend growth streaks. So in my mind, buying pharma companies when dividend yields are historically high and outlooks are questionable may be the most opportunistic time to buy, with the assumption the pipeline will continue to produce and revenues don't fall off a cliff. Or maybe the best diversification play in the pharma industry is to buy the sector via the ETF PPH and to not worry about patent cliffs. Another always looming negative for Sanofi and other pharma companies is product liability, which can result in potentially massive payouts if a company is found liable for unintended effects from their products. In Sanofi's case, they are currently in litigation over multiple products, notably Taxotere, Zantac, Talc, and Depakine, and the financial implications of these disputes is yet to be known but could potentially be significant. Now let's get into the foundation of the business, starting with revenue. Since 2016, Sanofi's revenue has been growing slowly but consistently, giving them a 10-year annualized growth rate of 3.0%, while their trailing 12-month growth rate is modestly faster, at 5%, which is still quite slow, but I imagine people are looking at Sanofi as a dividend yield investment, rather than as a growth investment. In terms of free cash flow per share, Sanofi's results have been variable, although trending up, with an annualized growth rate over this period of 2.8%, which is in line with revenue growth. The next metric we have is shares outstanding, which I think of as a proxy of financial wellness, at least for the types of companies I typically analyze. Sanofi doesn't really stand out here, having reduced their share count by an annualized rate of only 0.6%, which is neither a negative or a positive indicator. Another metric worth considering is free cash flow margin, which is currently at 16%, and this value is nearly in line with the level that it was 10 years ago, which shows that they haven't been stressed by inflation like so many other companies have recently, although their margin rates are quite variable. In terms of Sanofi's balance sheet, they have a current total liabilities level of $65 billion, according to Seeking Alpha. And for those of you who noticed, this value is converted from Sanofi's reported numbers in euros, while the revenue figures from Simply Safe dividends are in euros as well. Their total liabilities have been growing slowly at a 10-year annualized growth rate of 2.7%, while their cash and equivalents are currently at $9.0 billion and have declined by a 10-year annualized rate of just 1.8%. If we take their total liabilities and add back cash and equivalents and divide that by free cash flow, we get a useful comparison of true liabilities to free cash flow, currently at 5.8 times, which I think is fair for a pharma company like Sanofi. Or another way we could think about debt or liabilities is through interest coverage, which is currently at 18.2 times. In terms of valuation, Sanofi is trading at an objectively low multiple, at a trailing price to cash flow of just 9.1 times, which is a 10-year low for Sanofi. Or we could say value is at a 10-year high. If you're interested in using this platform, Seeking Alpha, and having access to 10 years of data, I have a discount link in the description below, which I would also be compensated for. Possibly the most enticing aspect of buying Sanofi at this point is the dividend yield, which is currently near a 10-year high at a trailing yield of 4.7%, disregarding this recent graphing area. And the current yield doesn't account for what the future yield could be, assuming their dividend growth continues, as it has historically. With a 10-year annualized growth rate of 3.2%, which is quite low, an improved 5-year growth rate of 5.3%, and a 12-month growth rate of 5.1%. And if we project the 10-year growth rate and the current yield of 4.7%, we end up with a projected yield on cost of 6.4% in 5 years with dividend reinvestment, or a 10-year yield on cost of 9.6%, which is quite respectable, with the key assumption the dividend continues to grow. And based on their dividend growth streak of 30 years, Sanofi has proven its ability to pay consistent dividends and continually create new medicines. Dividend history can be informative about the past, but the payout ratio gives us a current snapshot in time of financial stability and dividend safety. In Sanofi's case, they have a trailing 12-month payout ratio of 70% based on free cash flow, and over the past decade, the average payout ratio is also 70%. So this payout ratio is normal for Sanofi and seems sustainable based on this metric. One last element to note regarding Sanofi's dividend is that their distributions are paid out annually, which could deter some investors. In summary of the fundamental analysis, I see Sanofi as a similar setup to Merck as it was in June of last year, when Merck was also trading at a dividend yield near a 10-year high. And from there, it proceeded to skyrocket in price, and Merck had and has an even more concentrated portfolio of medicine than Sanofi. And Merck is arguably a riskier investment. But with pharma, you're always betting on the pipeline's ability to reinvent itself. Now let's see how Sanofi looks from a technical perspective. Here we have Sanofi, ticker SNY, over a 5-year time frame, and the first feature I notice is that their stock is on a downtrend and has had a negative return over this period of 9.8%, which explains their high dividend yield and low valuation. In terms of support and resistance, price looks to generally find support around this level of $46. Although it also breaks this level with some frequency as well, and typically faces resistance around $48.75 and $53. And in general, the price action is messy and range-bound. The next measure of value to look at is the current price in relation to the average price via the standard deviation channel, which shows the average price of $49.64 with this center yellow line, while the current price is just 5.8% below average at $46.78. Indicating slight relative value. Lastly, we see the relative strength index, or RSI, graphed at the bottom of the chart with this white line, which is about in the middle of the channel and doesn't offer a clear distinction of current value. That's all I have for Sanofi. If you're interested in a simple company with faster free cash flow growth than Microsoft, trading at a fair value, check out this video covering Sprout stock.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.